Financial advisors would love to find the magic bullet to timing the markets, but can these markets be timed? Joined today by Rob Arnott of Research Associates. Rob, welcome. So Rob, I'll pose that question to you. Can these markets be timed?
It depends what you mean by timing markets.
Okay.
If you mean picking tops and bottoms, getting in just before a market begins a bull market, getting out just before a bear market starts, forget it. Impossible. If you mean buying markets when they're cheap, averaging in as they get cheaper, and averaging out as they get more expensive, yes. Long-term returns are surprisingly easy to forecast. So if the goal is to invest in markets that are cheap and priced to give you good long-term returns, that's doable.
Over time, how can you accomplish this? It sounds kind of tricky.
It is and it isn't.
Okay.
It's not hard to gauge the long-term returns of markets. You can do it with surprising accuracy. Yield plus growth dominates the decision. Changes in valuation levels is also an important component, but that's fairly easy. Cheap markets are more likely to go up, expensive markets are more likely to go down. Put those three pieces together and you've got the long-term return. The challenge is really simple. If you have a long-term investment approach based on that kind of strategy, you will be buying what is most feared and loathed, what is most out of favor, and you'll be selling your clients' most adored assets that have treated them so kindly.
Now, I think oftentimes the biggest problem is this is something clients are demanding. They expect you as an advisor should be able to do this. How do you explain those challenges to your clients?
I would just explain it the way I just did.
Yeah.
That it's not possible. No one has that magic formula. It's funny, I have a crystal ball at home. It's a crystal ball that's literally that big out of rock crystal. You can't see a damn thing in it. There is no way to see the future. There's no way to see where the market turning points are, but it's fairly easy if a market is priced really cheap relative to historic norms to have high confidence that its long-term return is going to be great. You have to be patient because you won't pick the bottom.
Now, are there specific sectors where this applies more or less?
It's probably harder to judge sector by sector within the stock market and easier to judge asset classes.
Okay.
Today, for instance, the S&P 500 is trading at 25 times its 10-year average earnings, what's called a Shiller PE ratio. Emerging markets are at 10 times. Emerging markets are at a 60% discount. That's cool. Now, where were they 4 years ago? At the end of 2010, they were both at 22 times. But what happened was what I call the Fed wedge. Zero cost of capital in the US pushed the US market up, and the competitive disadvantage of markets that did not have free money pushed those markets down. Now we're looking at a situation where central bankers are more likely to begin normalizing rates, especially in the US, and so that wedge has an opportunity to close. Does that mean that I'm picking the bottom? No, it just means that I have high confidence that those who buy emerging markets now are going to be very pleased with their choice in 5 to 10 years. 1 year from now, who knows?
I'm going to ask you to take out that crystal ball one more time. What is your outlook for 2016?
My outlook for 2016 would be that we're going to see some normalization of markets relative to what we've seen in the last 3 to 5 years. Value's been crushed. Value managers have been hit hard. It's a tough time to be a value manager. When that happens, I kind of get excited because I want to rotate into a deeper value tilt when that happens, because value will come back. It always does.
Those are some great insights. I'm going to hold you to that prediction.
I hope so.
Great. Rob, thanks so much for joining us.
Thanks for the invitation.
For Investment News, I'm Matt Ackerman.